OptionChampion.com.
Today is Saturday, October 29th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications. Nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade. On this Saturday, cash market indices were green across the board for the week. The Dow gained more than 1,700 points. The S&P 500 gained 148. The Nasdaq Composite gained 240. The Russell gained 104. And volatility came in by $3.94. Crude oil gained $3.24 on the week. Gold lost $14.20. Silver lost 20 cents, and natural gas ended the week higher by 25 cents. Today we're going to look at adjusting a collar position when there's a decline in the underlying stock price. A collar position combines a covered call with a protective put, with the covered call paying for the protective put, and ideally resulting in a credit to reduce the cost basis on the long stock. This week's trade was a collar position in Micron Technology, where I was long the stock at $56.25 per share, short the 57.5 call, and long the 52.5 put, with both options in the December monthly cycle at 52 days until expiration. I sold the 57.5 call at $3.83 and used that collected premium to buy the 52.5 put for $2.32, keeping the remaining $1.51 as a credit and thereby reducing the cost of the stock from $56.25 to $54.74. The short call and long put benefit from a decline in the stock price, as the short call loses value and the long put gains value. My plan behind this trade was twofold. The upside plan was that if the stock price were to rise beyond the 57.5 strike of the short call, then I would allow the shares to be sold at the 57.5 strike and the long 52.5 put to expire worthless and keep the $1.51 mentioned a moment ago. The downside plan was that if the stock price were to decline, then I would buy more shares to achieve a lower average price per share and roll the options down to lower strikes. Well, 2 days later, Micron fell to $53.23. So I added shares to my position and reduced my average price per share from $56.25 to $54.74. Same reduced price as before with the initial credit. And then I rolled the 57.5 call down to 55 and the long 52.5 put down to 50, receiving a 49-cent credit on the roll. As for future adjustments, I'm currently bidding $47.25 on the stock. If the stock price continues to decline and I get filled on additional shares for $47.25, then my average price per share will be reduced even further to $52.24. And I'll roll the options down to the 52.5 call and 47.5 put. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.